Oliver Haarmann, co-founding partner at Searchlight Capital Partners. Oliver, it's absolutely great to have you with us this morning. Thank you.
Thank you.
For stopping in. Let's start there. We were just having a conversation earlier in the program about how disruptive AI is proving to be for white-collar workers. From where you sit, at one of the premier private equity houses in the world, what does it mean for you? How are you playing this theme out when it comes to your investments?
Well, thank you. Well, obviously, AI is everywhere. You can't ignore it. It's more than just two letters. It seeps through the whole economy, every company. We think about it both internally at Searchlight. What can we do to run our business better at Searchlight? So we have an in-house data analytics expert and a whole team around him. And we do a lot of work around how do we make our own businesses more efficient? How do we find interesting opportunities? And most interestingly, how do we see trends across all of the companies we own, across multiple continents, multiple economies, multiple industries? And that's really helping us be smart. Of course, when we're making new investments, we have to put the other hat on and think not only what are the opportunities, where can AI enhance this business, but also where's the threat? How can it disintermediate a business that's been a great business for many years? And you touched on the fact that professional services, white-collar services, they've been a big investment area for private equity for many years. Why? Well, they tend to be businesses that have good margins, good growth rates, not that much capital employed, so generally very attractive returns on capital. So legal services, accounting services, information media services, big sector testing and equipment services, big sectors for private equity. We've actually kind of saw some of these trends coming, that might be a risk in the AI world. And we started switching about 3 years ago more towards focusing on environmental and infrastructure services as an area that we thought would be interesting to invest in. They've generally traded at lower valuations just because people thought they were less growthy, maybe slightly lower margins. But what we saw, looking through all of that we saw an opportunity for margin expansion, but we also saw an opportunity that those services are going to be hard to disintermediate. You still need to go out and do the maintenance or the repair of a broken water line or an expansion of the electric grid, or here in London in particular, we've been doing a massive upgrade of water pipelines, as we all know, which have back to the Victorian age. So there's just a lot of, we thought these are services that you have to do physically, so you can't disintermediate them with AI. And on the back of that, not only have we seen good growth in those companies, we've created more jobs in those companies, and they've been growing and improving margins.
When it comes to the private equity asset class overall, private equity sector, it's clearly been a difficult period. We saw so many private equity firms bulk up on deals back in 2020, 2021, and now with rates higher than where they were, a lot of the economics of those deals don't seem to work, and we're seeing a struggle with exits. How would you describe the current exit environment and the private equity sector overall?
Yeah, you're right. Overall, the sector's definitely been struggling with that. Part of it is people paid big prices, put on a lot of debt, and that debt was at very cheap rates. Now, as interest rates were rising, people felt they were stuck with businesses that were slightly worth less, but they couldn't really sell them, and they were getting squeezed on their profit margins and cash flow because interest rates were rising for a while. So you were in this awful situation where almost, people throw around the word zombie companies. You don't have enough. You don't have enough cash flow because of the rising interest rates to keep investing in growth, and there aren't potential buyers for it. And that's a really big challenge for our whole industry. Now, thankfully, we've actually been on the other side of that. Over the last 12 months, we've sold $4 billion worth of businesses and only invested about $2 billion. So we've been focusing on that. And I think the unseen trend right now in private equity is the return of the strategic buyer. The corporate who wants to acquire a new business that they think is strategically important. We've exited almost all of our businesses to strategics. And that's a big compliment. We always feel that's a big compliment, not only because often, they pay you a fair price for your company because they like the business, they have synergies, possibly growth opportunities, but we also think it's a stamp of approval that we're investing in good businesses that we want to make better. Ultimately, our business is investing in good businesses that we want to make better. It's not that hard when you boil it down to that. And, it's kind of a pat on the back when the buyer is someone who's in that sector and thinks Absolutely. It's a good business.
That's really interesting around a strategic buyer, because I do wonder whether it's because it's part of this AI trend already starting to emerge. I spent the early part of my morning reading an EY report and they were talking about it now being a third lever for the private equity space, where you had the financial engineering, which we've often spoken about, that private equity has been fixated on, the operational excellence, improving the business. But this third lever now being AI. And if we are talking about finding strategic buyers, it feels as though AI can find the gap in the market, the opportunities much quicker. Is that what we're talking about here? AI is just improving the ability to connect up buyer and seller and find those opportunities much quicker than previously would have been the case.
Well, there's definitely an element of that's creating more information that allows people to be more efficient in finding opportunities. But I think you're also hitting in an interesting trend there, because the three levers you mentioned, financial leverage, that's been really only available to private equity, and corporates and strategics don't really use that so much, especially if they're publicly listed. So they were kind of off that playing field. Then you look at operational efficiency, which often the strategic has a bit more because they might own another business and they can drive more growth and opportunity. But funny enough, AI is kind of an equal opportunity. You know, private equity people can take advantage of it, but obviously strategics and corporates looking at their businesses can use these AI tools also very, very effectively. So I feel like it might also kind of be leveling the playing field more for strategic buyers who don't have that first tool, which is the leverage.
What about that speed element? Because we've been in this vacuum of deal making for a while, and it's only starting to gather pace from here.
Yeah.
The promise of AI is that it speeds up due diligence. You can get through much more of the paperwork.
Good
you
idea,
can see
good
what you're
point.
buying. Does that mean that the flurry of deals, when they truly have started to happen, will happen very, very quickly because of that AI element?
You're right. I mean, it doesn't make it more interesting for people to have information and find opportunities, and then it does accelerate diligence, very important. But ultimately, you know, the most important factor in general in deal making is interest rates, right? Interest rates, in a way, are the oxygen of all financial markets, even for people who are less leveraged. So clearly, you know, I think a big part of the growth in deal making has been the oxygen in the room, which is that interest rates have been coming down and are expected to come down a bit further. And that's obviously good for both financial buyers, but also for strategic buyers.
I've already flagged up to our .com teams a lot of what you've said. I think it's fantastic. I love the net seller side. I love the zombie company side. I love the fact that strategics are back. So we're going to get that written up as well. But there are ramifications of what you're saying, and I'll make two very quick questions if I may. One, JT and our guest yesterday were talking about more PE companies in North America than McDonald's, which is, I keep mentioning because I love the stat.
Are you hungry, McDonald's?
I don't know. Anyway, I'm not going to go into my fast food, but yeah, I'm quite hungry. But in terms of the private equity sector, it needs a reckoning, doesn't it?
When you say it needs a reckoning, what do you mean a reckoning?
I mean,
like,
there
is
are
that a positive thing or a negative
no,
thing?
I mean, there are thousands of very average companies out there that call themselves private equity companies that are overpaying for assets, your words, not mine, that are creating zombie companies, your words, not mine, and are just buying them off each other, actually, at the wrong price.
Well, I think what you're seeing in the market, especially now, you're seeing a separation of quality, a flight to quality.
Yes.
You know, so firms like ours, which have been, and the investors now are looking at more than one metric. They used to look at IRR. Now, IRR is the return on your invested capital.
Of course.
Right? It's a financial calculation, very important. They're increasingly looking at DPI, which effectively measures what's the cash you've given me back versus the cash that I've put into your fund. So it's a very simplistic measure that goes to liquidity, while the other measure's always been on return on capital. And as investors look at that, they're really starting to separate people who not only drive good returns, that's table stakes, you've got to do that, but they're also looking for people who can drive cash back into their pockets to reinvest in private equity or elsewhere. And that's, you know, we've really focused on excelling, and you'll see the firms that have been raising more money like us and ours excelling on both of those metrics. So we do, and look, it's healthy in any industry that ultimately the quality, you know.
For sure.
And our business in some ways, because at the end of the day, it's about returns and now DPI, it's easier to measure. There's not a place to hide.
Oh, I could follow up on, is it about return of the capital, return on the capital, but I won't. What I will say to you is you're a net seller, 4 billion out, 2 billion in. Do you think then that actually, in terms of the economic cycle, that this is the time to be a seller of assets more generally?
We have definitely seen that, and we've believed in that. The question is, do you have businesses that you've built and created that are good enough to attract, you know, attractive bids from trade buyers or others? And have you managed your debt so you haven't gotten into zombie situations? You've bought good businesses with moderate debt, driven growth because you had the excess cash flow. And as a result of that, you're able to get good valuations. So I think you're right. And we have a big, healthy pipeline of more potential exits.
Fantastic. Thank you very much indeed. It's bittersweet for me. Sweet because you're a great guest. Bitter because you made me think about food. Not good. Oliver Haarmann, thank you very much indeed for joining us.